faster works, democratizing
1.7.
Let me read it.
1.7.
Outpaced the S&P. So have I.
Look
Not
at the
to
one
brag.
on the right. Look at that art. That's art.
I like Keith Haring.
Lowest correlation.
Do you know about Basquiat?
Do I know about Basquiat?
You really don't. What are we? 47? 47. Round of applause, ladies and gentlemen. We're going to have an awesome show tonight. I'm so excited. We have tequila in the room. Stocks closed green today. Modestly green.
It's 3:30. Do you know what time it is?
No. Wait, where are we going to close?
The market's it's still going.
Oh, look at this leg down.
I'll let you know. Keep going.
Where's the 10-year?
Just
Give
keep
me a
talking.
read on the 10-year right now.
That's not what people are here for.
I honestly think that matters more than anything that's going on in the stock market.
275.
Yeah, it's good. Keep it down.
I'm making that up. I don't know.
All right, Dan McMurtrie is here, and if you're a fan of the show, then you are definitely a fan of Dan's. Dan is here for a 21st time out of how many shows? 46?
47.
Is this your fourth show?
I have no idea.
I think so.
It is.
Dan is not in costume this time.
Yes, he's headphone manager.
Yeah, now I'm dressing up as hedge fund
costume.
manager.
Good call. Do you know the origin of that vest? Why that's a hedge fund thing?
I have no idea.
You just do it because everyone else is doing it?
Yeah, it's just
Josh is going to tell you.
I feel like I need a
Isn't
vest.
it a point SAC?
Yeah, it's an SAC thing. It's a Stevie thing.
He just cut the sleeves off one day?
No, so he kept his trading room like 60 degrees
Ah.
because he wanted everybody alert.
Does that work?
I swear to God. So the guys are wearing, button-down shirts.
Right.
And then it's like they need a layer. So that's where the vest...
Makes sense.
That's the origin of the vested hedge fund trader and or PM.
I didn't know that.
So you're carrying on a very important tradition.
There we go.
Dan's the founder and CEO and portfolio manager of Tyrell Partners, New York-based hedge fund. I did this whole thing for you. Focusing on trends in supply chain, technology, healthcare, industrial, and consumer markets. Dan is a partner at Anchorless Bangladesh, an early-stage VC fund targeting the startup ecosystem in Bangladesh. Dan has a wealth of experience in financial markets, including analyst roles at Griffin Capital Management, BP, Nuveen Investments, the Center for the Study of Financial Regulation, Oppenheimer & Co., and Junhee Law Firm. Say more about that. What is that?
I was at Notre Dame, and I had a weird opportunity to go live in China for like a year and a half, and I was trying to get an internship in China, and so there's a guy at Notre Dame who knew a law partner at this M&A law firm in China, and so in China, things just work kind of differently. So their judiciary branch, their executive branch are not separate. So, there's a lot of stories about kind of white guys getting defrauded in China.
Yeah.
And what you'll find is if something bad happens to you in China, you can go to the court, and the court actually will kind of give you a reasonable ruling.
Yeah.
They're going to give you a very nice piece of paper, and it says, you're absolutely right. They stole your stuff. That's really terrible. And you're like, hey, can I get like enforcement on this? And they're like, oh, no, we don't. You got to take that to the party. And then you go to the party, and the party's kind of like, well, what's our interest in enforcing this? So if you're looking to do any sort of deal, you need to understand what the law says and also what the reality of the party is and interests, incentives, all this other stuff. So it was a really cool experience getting to see how that worked. I got to work on a couple big U.S. corporates buying assets in China. And like you can't technically own a lot of these things. So it's like technically a perpetuity lease. And it's just a lot of
the whole
weird
Chinese property
situations.
market is 100-year leases.
Right.
Nobody owns property. The party owns the property.
Right.
Well, the people own the
Right.
property. Right.
Which sounds a lot scarier than it is, right? Because you hear that and you go, that's absolute madness. But if the entire system is used to that, it does generally function as anything else would. But
also, you're not going to own anything for 100 years anyway. You can be dead.
Right.
So why do you need to?
So, but the risk is the kind of the tail scenarios. And if you're an outsider coming in, it's very, very risky. You don't want to go in there without. And so you hire a very expensive, nice law firm because they know the right people and they can give you the kind of the no bullshit answer on here's what's actually going on here. Here's what your actual exposures are. Independent of. It's kind of like you're looking at some of these, this Twitter situation right now, and there's a certain legal interpretation, and then there's kind of a practical reality of. Will the SEC step in? Something like that. We're seeing some of that in the United States right now, but in China, that's always been the case.
I was going to say, don't you feel like that's the story of the last 5 years?
Yeah.
Where people on Twitter are outraged. They're like, oh, did you see what they just did?
Right.
And then it's like, well, what are you going to really do about it? And then a lot of things that we thought were laws turned out to just be norms. And once you violate a norm and the initial shock wears off, it's like, yeah, we just did that. We just drove a car through your house.
Speaking of norm, I hear there's like a
Yes.
Netflix special coming out.
Yes.
What? What am I
Norm.
missing? Oh, really?
Yeah.
Norm Macdonald apparently recorded a comedy special before he passed away.
And they sat on it all this time?
No, apparently he did it like in the final weeks. And he did it alone in a room. And it's just him apparently saying whatever it is he wanted to say without repercussions.
Not wait.
And
Here's what I really think. As if he was
Right.
filtered already. He never
That's
cared.
gonna be good.
yeah, but I mean, I
I'm
don't
already
know.
offended. I haven't even seen it.
Right.
so.
I mean, I just, I have no idea what he's going to say, but
Yeah. Wow.
it's going to be weird.
I have a feeling we're gonna be fans. We're gonna be fans of it. All right, good to know. So where are we starting today? Are we starting with .com 2.0? Is this 2000 to 2002 all over again?
I think it kind of is. I just think it's sped up.
It's way faster.
Yeah,
Everything is.
It's on a 5 or 10x clip, which is the way it's been.
That's reasonable. I'd buy that. You know what the difference is though? Back then, interest rates were 7%,
right.
and now we can't even handle 1% Fed funds rate. I mean, that's a pretty scary situation.
Well, I kind of flip it around. Jim Chanos has a line where he says, in 2000 there were a bunch of these companies that were 2 to 4 billion and he made a ton of money on the short side, shorting. He's famous for Enron and these other guys, but what he'll say is there are all these other companies that were 2, 3, 4, maybe 5 billion that went to 2 to 400 million, and now
So they lost 90%,
Right.
but they didn't start from 100 billion.
right, and
Okay.
now right, those
The fraud-
same those same kind of concept stocks are 20, 30, 50, 100 billion. And so I just think the valuations, if you sort of scale adjust everything, it kind of makes sense. I mean, we were at a much higher level of absolute valuations for companies that were still, the companies were still kind of ideas from a business sense. They hadn't really validated their economics. There are probably good reasons to think they could have, but they had yet to produce a dollar profit. And when you're dealing with a company where financially the valuation is all in the terminal value, it's all 10 years out plus profits. I mean, it's an opinion. And so you're dealing with these crazy valuations. I think it kind of,
Counterpoint, they have revenues this time.
that is an improvement.
These
yeah.
were business models. They were
Right.
$4 billion business models, which I don't know
Right.
which is worse.
Well, one, I push back on the revenues thing because I do think there's a question of like, how much money do they spend to get those revenues? And that's kind of the problem. There's a lot of businesses that have, $2 billion in revenue, but they spend $7 billion to get that.
Yeah.
Does that really make sense?
Here's what I think. The unwind is similar, right? Just
Yeah.
the collapse is similar. And maybe that's where it ends. Mark Rubenstein, there's a few good counterpoints. Mark Rubenstein, I think this data is from the Loothole Group. The tech sector peaked at 34% of market cap in 2000,
Right.
but it only contributed 8% of nominal GDP.
Right.
This time around, it peaked at 27% and contributed to 18%
Yeah.
of GDP.
And
You know,
those are probably
you
understated.
know what the problem is with that though?
What?
A lot of the companies that we're talking about are not classified as tech. So the semiconductors are, the software as a service companies are.
I think they're reclassifying them. They're reclassifying Google.
they're throwing in Amazon
Yeah, I think so.
and Netflix. Like these are consumer discretionary or communication stocks.
Here's some more good stuff. This is from Gavin Baker. The trailing 12-month EPS for the largest tech companies. So Gavin Baker, just to set this up, is saying we're 21 months removed from peak big tech valuation, which was 2020. So we're 21 months removed. He said trailing 12-month EPS for the 10 largest tech stocks declined 73% in the 21 months post-peak valuation in 2000. Trailing 12-month EPS for the 10 largest tech stocks today has grown 71% since peak valuations 21 months ago. So to approximate a 2000-style meltdown, earnings per share for the 10 largest tech stocks today would have to decline 73%.
happen.
Which is not going to happen. Last thing. So Gavin says this is nothing like the year 2000 in terms of either valuations or bottom-up fundamentals. Last point, Y2K multiples would have taken the NASDAQ to a peak of over 30,000. Instead, it peaked at 16,000.
What if he's looking at the wrong stocks? Take out the top 10 tech companies, and maybe it's probably more similar.
So we're
I
talking about
agree with-
Coinbase.
Yeah, I agree with Gavin's point, but I think the way he's getting to it doesn't make a ton of sense.
Why?
Because nobody's really like in 2000. You're talking about Cisco, Microsoft, those companies at crazy valuations. We're not Microsoft, Amazon, Facebook. Netflix has gotten
Those
tagged.
never got crazy.
25
These are
times,
not
30
these are not
times.
ludicrous.
So the
numbers.
crazy was not there. It was one step below, which were
Right.
still huge companies.
Mid-cap tech.
Which were still
Well,
giants.
no, not even mid cap. Large cap tech, not mega.
Not mega.
We didn't have we
yeah.
didn't have that distinction back then. But think about like ServiceNow, Workday, CrowdStrike, which these were 40, 50 times sales.
All right, here it is.
Yeah.
So Coinbase got to $75 billion in market cap. It's now 14. Peloton got to 50.
Right.
It's now 5.
Yeah.
That's .com shit.
Yes.
Yes.
Yeah, that was, look, there's a lot of smart people who are losing a lot of money right now. And I don't think nobody wants to be like grave dancing or I'm not meaning to be disrespectful to anybody, but everything that's happening is exactly the predictable outcome that has happened since the beginning of time. Like there's nothing that's happening in any of these markets that is unpredictable. The commodity market, it's a classic capital cycle thing. We didn't invest for 10 years now. We don't have enough commodities. That's the day one outcome.
You could predict the outcome, but not the moment it's going to matter.
Right. And also the path
The start
there,
of it.
I think what some people maybe miss is if you didn't play that game, it was incredibly hard to survive the last 5 years. Like,
If you were different.
yeah, even if you were like a long biased manager, if you weren't willing to participate in high multiple stocks, you underperformed so much that how did you stay in business? And I know a lot of people
Writing really good letters.
who are writing really good letters who shut down their businesses. And I also, what's his name at Horseman in London, the short seller, Russ, right? He shut down like right at the top. Like it was brutal to make it through that period. And so, like, it's if you look at all the money managers that, and I think there was a chart last time I was on here about this, but it's kind of like an evolutionary process where if you don't have the right traits to survive in that environment, you die. But then if the environment changes, the guys who survive die. And I think that's just what's happening right now. Yes, it's the obvious thing, but it's not like these people are
a really
stupid.
good example of somebody who refused to play the game and was able to survive, I think, on reputation and just people remembering.
Right.
This guy usually in the end ends up right.
Klarman?
No, David Einhorn.
Yeah.
Yeah.
He refused to play,
But he's definitely killing it this
but
year.
he kept a low profile.
Right.
Like he wasn't out there screaming the FANGs are
No.
overvalued. He stopped doing that.
Well, he was in 2015.
But I'm saying the last 3 years.
Yeah. Correct.
During the pandemic, he was not on Twitter
Nope.
yelling at people about stock valuations. He kept his head down. He stayed out of that game. And it looks as though, once again, I don't know, maybe it's the fifth cycle, he's being vindicated.
But you know what?
for
It took so long to
But
get
my
here.
point is there are not a lot of people of his stature
Right.
that could have survived that.
Based on reputation.
Well, yeah, and I think the thing is, like, there's a pretty good number of money managers, fund managers, whatever, that have exceptional 5-year records. There's maybe 10% that number that have exceptional 10-year records. But then when you look and you get to people who have 20-year records, there's like no one. It's like 50 people ever, right?
It's so hard.
This is why. Because the exact thing that would allow you to survive the last 5 years will kill you in 4 months.
Yeah.
Just over for you.
God.
And I mean, how many brilliant? I mean, all these guys have 50 IQ points on everybody in this room put together, and I mean, their track records are impaired.
Okay, but hold on. Here's another dimension to this. A lot of this is where does your capital come from,
Right.
and what expectations are you setting on that capital? And very wisely, a number of hedge funds 10 years ago started setting up reinsurance operations,
Right.
which maybe is not powering the entirety of their hedge fund assets under management, but it's permanent capital. Not permanent is the wrong word. It's coming in regardless of your performance because it's not coming from investors. It's coming from people paying premiums.
You know who's done the best job of that? And I mean, people like to bag on him, but Bill Ackman,
Yeah, he did that.
is like the most improved player of his kind of like cohort, I guess, because he got tagged on Valiant, a few other things. He had just a rough period. He raised permanent capital in a vehicle that they can't ever take away from him. He stopped doing the things that weren't working. And then, Bill's always had.
What is he as a publicly traded reinsurer in Amsterdam or something?
It's like a closed-end fund.
Okay.
So you raise money. It's like a mutual fund, but you raise money once. And when you're investing in a mutual fund, right, you're putting money in, new shares are being created, they're buying stuff for you. The closed-end fund, they just issue the shares, then it's a fixed pool of money, and people can trade the shares.
But the capital is there.
Right. The capital's locked up. So it's
people
kind of like
could buy or
it's
sell
a
the
company.
shares based on perceived discount or premium to NAV.
Right.
But he has the capital to
Right.
invest.
And at points, I think that the discount to the assets was like 30 or 40%.
Yeah.
When people didn't have any faith that he was going to come back. But he didn't get any of the capital pulled from him. And the guy just continues to improve. I mean, I'm incredibly impressed. And everybody was making fun that he made the Netflix investment and then he cut it. But I'm like, look, you're the best in the world at this. You're right 60, maybe 65% of the time if you're a god.
You know what marks somebody that's not really in the business? A willingness to make fun of other people for having down positions.
Right.
It's like, are you f***ing kidding me? Like, do you invest for a living
Right.
and you're never wrong on anything you do? What are you saying?
And Dan, to your point, 2014 Ackman would have held on.
Well, he did.
Yeah.
He did hold on to he had multiple big positions move against him. And
no. 2014 Ackman right now
on TV.
would be in a 13D battle with Netflix.
Right.
And start calling the shots on what shows to make.
Hey, you know
Like
what?
starring in the show. Not only do I want 2 board seats, I want to be on the next season of Ozark.
You know what was
Right.
predictable in hindsight?
Actually, I think he'd be good in Ozark.
I think it'd be great.
Yeah.
But, yeah.
Walmart and Target. Just this idea, like when that happened, I felt like such an idiot. Not that I short companies, but like these are discount retailers for the most part. And of course,
a little bit more discounted now, wouldn't you say?
Of course.
Come on, John laughed.
Of course,
Heavily discounted retailers.
Of course, they're going to have to absorb the inflation, right? And their margins were going to have to get hit because they can only pass on so much cost.
Right.
Big
Those are weird.
Not a big shareholder. Walmart, Target.
Yeah.
No.
Nobody owns those things. No, I mean, those are weird. I mean, there's a
Wait, why are they weird?
So there's this really weird thing happening. And part of it, like, keep in mind the last X number of weeks, you've had a lot of major investment operations winding down. People are having to act for reasons that are not fundamentally oriented. They're like, we have to stay in business. We have to return capital. We have something going on. We can't, they're not just sitting there doing calls and building models or whatever. And so what was weird was leading up into Walmart and Target's print. Hedge funds will pay experts, people who work in the field, whether it's, a distributor of products or something, say, hey, like, how's business? What's going on? What's the inventory situation? Because the company can't tell you things, but other people in the world can. And it goes back to, like, if you ever read like Peter Lynch stuff. So leading up to those are 2 of the biggest, most important economically companies in the world.
Yeah.
If you talk to anyone who worked around any of these companies, anyone, they were all like, the inventory situation is just ass backwards. We have a huge problem. There was a shortage in 2020, 2021. Then it slingshot back. There was too much. At the same time, it slingshot back. And keep in mind, when Target and Walmart want to have clothes for the spring, they got to order that in Q2, Q3 of the prior year. It takes time to make this stuff and ship it, and shipping has been hard. So you had to over-order and order in advance.
Double order.
To handle all those problems. And so the exact time all that inventory finally shows up, that's exactly when the consumer rolls over. And so there's a lot of people who are like, oh, they mishandled the macro or they mishandled the supply chain.
Yeah.
And I'm like, no, you've never worked in a real company. Like, they did not have any good moves here. And you know what's not a move if you're on Target? Not having stuff. Because your consumers will leave.
Does Target have macro forecasters on there?
Oh, yeah. I mean, they have, well, not macro forecasters. They're not, right, but they do. Like, they're not,
of course
you know.
they do. Yeah.
Target has a hedge fund telling them when to order children's clothing from China. Well, I think that's a really good point. Sometimes in business, there's no win. There is how do we lose less? I think you lose less by over ordering inventory and then discounting it later versus people come to the stores and you don't have anything to sell them.
Yeah.
Well,
Can't imagine that being smarter. So
let's get back to the Dotcom shit. John, throw up this chart.
Well, wait, one point on that.
Go ahead.
That's what's going to happen. That's going to be the story of the next 2 years, I think.
What is?
There are going to be companies who overextended themselves and they're going to get stung because there aren't a lot of good moves for a lot of businesses. Shutting down your business is not a good option.
yeah, we don't like the environment. We'll see you in 6 months.
Yeah, right. We're just, Chipotle is no longer open. We'll see you when chicken prices come in. That doesn't work. You can't do that. You have to. And the reason customers trust certain companies is good times or bad, they provide the service and they provide it at a reasonable price. And sometimes that company has to take a margin hit and sometimes the company has good margins. And over the next year or two, and this is what we're focusing on at work, there are a lot of companies that are set up where, yeah, they're going to take a profit hit for 1 quarter, 6 quarters. I don't know yet.
Right.
But they are going to take so much market share from mom and pops, from regionals, from worse capitalized other players that can't afford to provide a good quality product to their customer.
Isn't that in line with this shift that we're seeing in flows to dividend aristocrat ETFs and Vanguard's high yield stock? Like people are back to return of capital versus return on capital, and they're looking for dependable businesses that have been through cycles before.
Yeah, I don't think that's necessarily why they're doing it, but it has kind of the same effect, right? So they're ending up with companies that are going to naturally, you can go out and you can take market share. Like you guys could go out there and directly attack another RIA.
Yeah.
Just start tweeting them into the ground or something. I don't know, but or you could be in a position where other people go under and their clients are like, where do I go now?
Survive.
And they go, yeah, right. And so it's a survival game. And the companies that have built out really strong culture is going to matter a lot. It mattered in 2020. It's going to matter now again, because if you freeze up in these periods, the company that has, a bunch of scrappy 25-year-olds running around and saying, hey, there's an opportunity here. I can go test it. We don't need a lot of money.
Yeah.
They're just going to run laps around you. And,
So you guys are buying WeWork?
Oh my God.
Is that what you're saying?
Yeah, that's exactly what I'm saying. No. But I think there's a lot of companies right now where if you're a mom and pop investor, retail investor, you don't need to run out to buy these companies. You have time to actually go and look at them and do kind of a Peter Lynch type thing and figure out, okay, and is this company going to be a winner over the next 2 years if times are lean?
There's a weird thing happening right now where people are like, everyone's bearish,
right,
and everyone's looking for a bottom.
Right.
Hard for those both two things to be true.
Yeah.
But I think what you said is one of the silver linings of this moment is that there's no rush.
Right.
In 2020 and 2021, stocks went up every day. There was a 5% pullback in each of those years post the COVID bottom in early.
And that's why you're seeing that sentiment, because the thing that I'm afraid of as a long short hedge fund manager is the big up day, because that's when my outperformance gets obliterated. The market goes off 5%. My fund's up 20 basis points because my shorts go up 5 times as much as my longs.
But confidence evaporated. So don't you think are we in sell the rip mode?
No, so my point is you don't have to.
Right.
You when markets are trending higher, you can't think straight. You just like, I can't believe I don't own this. I can't believe I'm not in this. Get me in it. Nobody's in a rush now. That's why you see a stock go down 40% one day, and then the next day go down 5%.
So I keep saying that I'm waiting for
urgency.
I keep saying that I'm waiting for a higher low to just get a quick trade on these growth stocks. But stocks are by definition in a downtrend. We're making higher lows, right? We're making lower highs.
Yeah.
We're making lower highs.
Yeah.
So what's the rush?
There isn't.
It's just we're in a downtrend.
There isn't, because now they're talking about the possibility of earnings tipping negative in the back half of this year. Nobody that just started investing in the last 10 years has ever seen earnings falling and multiples falling at the same time. Nobody. Right. That's a double negative.
Well, that's what happened in the dot-com bubble. Is both those things. So John, throw up this chart.
But also, investing is not gambling, of course, but let's use some gambling terms for a second.
Did you just f***ing wink while you said that? Do we have that on camera? I caught a wink. All right.
But everybody's bankrolls are getting just jacked. Everybody, everybody has their asset allocation plan, but their bonds are trading like biotechs. Their crypto is trading like crypto. The
snozberries taste like snozberries.
The snozberries taste like snozberries.
Can I tell you what happened this week, though?
What's that?
Last week, I think I'm not saying bonds bottomed. I'm saying there was a bottom.
Josh keeps calling a bottom. Josh keeps calling a bottom in bonds.
I'm really not. But a bottom. TLT ripped yesterday with the market crashing. Right. And that was not happening in April. That was not happening in March.
Yeah. Look at this. Yeah, it's a bottom.
It's a bottom. Not the bottom. Bottom. It's not a bottom.
It might be.
There's your higher low.
It might be. No, you're right. You're right. Higher lows months. All right.
Yeah, go ahead.
All right. We're looking at price to sales ratios. Is this price to sales or forward? Yeah, price to sales.
Forward
revenue multiples for public software companies.
Shit got so out of control.
What is that blue? What is that light blue line? 25 times.
Fintech.
Of course it is.
So all right, I'm just looking at.
That's the biggest bubble of all the bubbles, right?
Yes.
More than EVs.
No. What about SaaS?
Yeah.
Snowflake went.
These are SaaS. Fintech is kind of sassy.
There's not going to be a business there for fintech. There's no pot of gold at the end of the rainbow. Somebody in EVs is going to
payment for order flow. What do you mean? It's great.
Yeah. Snowflake went from 180. It's still at 36, which is hilarious. Uber. Well, I don't know why I'm saying Uber went from 9 to 2. I mean, all of these things. What did Peloton do? God only knows. Peloton went from Peloton went from 20 to 1.
All right, so
Peloton went from 20 times sales to 1
because sales are falling.
Look, can we just stop for a minute and acknowledge that people bet that Americans like to exercise?
I was against that. I was on that idea. I said name one successful exercise or fitness related company in history.
Do you
One
guys
of my dad's best friends growing up sold exercise equipment. I watch him live this cycle. I've seen him go through like 15 of these, and every time the product's awesome. It's really cool. It's the coolest
All my
thing
friends
I've ever
are doing
seen.
it.
Everybody gets it, and then they die overnight. It's the most
do you
bizarre
know
thing.
do you know the science of hitting?
Yeah.
He has a great newsletter. This is Peloton subs year-over-year growth. To you guys' point, just dead. Collapse.
I went through this on TV once. I was just like, what are we saying here? Are we saying all of a sudden, like as a society, we're all going to be healthy? And we're like, because think about how many busts Fitbit.
Nobody's saying that.
Well, at the time,
I mean, but this is impressive.
you don't understand.
This is impressive.
It's not a treadmill. It's a platform. You don't understand, right?
So obviously growth flatline, but come on, they went from like 0 to a lot. And I know it was all pandemic, obviously.
Yeah, I was waiting to come over the top with that. But yeah,
it was
I
all
mean,
pandemic.
you can see exactly when people get locked in their homes and can't do anything
If you
else.
squint, yeah.
Right.
Bally's Total Fitness went bankrupt. Town Sports, remember New York Sports Club,
Yeah.
DC Sports. Every single one of these. The only exception so far seems to be Planet Fitness
Because it's $10 a month.
because it's like average Joe's.
Like, well, they're
It's
no,
like
but yeah,
no
but
commitment at all.
Planet Fitness's business model is explicitly, basically, we're going to sell you this lie that
And
you're going
nobody's
to go to the
gonna
gym,
come.
and nobody goes.
and
nobody
you're gonna
cancels.
own,
I
and
think
you're
they-
gonna love it.
And nobody cancels because
Yeah,
it's $10.
I think it's like 5,000 members per store or something. The
Dude,
number is
it's
crazy.
genius. The only day you can't
Right.
go anywhere near there is January 1st.
Right.
January
yeah.
2nd.
Yeah.
Don't go anywhere near Planet Fitness January 2nd. Other than that, you're fine.
So
They sell pizza in the locations.
the reason why I think it's like there's no, to Josh's point, both your guys' point, there's no like urgency here. Even though the market got killed, we're only starting to see the ramifications of all of the inflation. We're only starting to see layoffs. Like it really hasn't even started yet. John, throw up this layoffs picking up chart. It is only
What is layoffs.fyi? Is that the new hot site? I keep seeing that referenced everywhere.
FYI.
Layoffs.fyi
I don't know about this.
is the website
Okay.
that FT is citing.
Yeah, I think somebody put that up as like we're going to track.
Okay.
Yeah, this is a
So
startup tracker.
we got Netflix laying off 150 people. That was announced 2 days ago.
But this is not that. This is startups.
Startups.
This is not Netflix.
Well, this is going to spike.
Both Walmart and Amazon said on their calls that they're overstaffed.
Wells Fargo too. Wells
These are
Fargo is
two-
cutting.
But those are the number 1 and 2 employers in America.
Amazon will, yeah.
So if they're overstaffed, what are the odds that we're going to see a labor market this tight 2 months from now?
Not good.
Not good. So which helps the Fed.
Well, how many-
arguably.
Right, and that's
So we're rooting
yes.
for layoffs. Okay, this isn't weird at all.
Yeah,
How many job openings are there?
there's no way to have this conversation.
11 million.
I know that could
No,
get,
there's just 11.
that, yeah,
11
that could get cut in half. Those could be artificial.
College educated unemployment 2%. It's not. We can't carry on like this. I've met a lot of these people who went to college.
Yeah.
Dan, what do you
nothing
think?
special.
What do you think about Coinbase specifically, and maybe just like a broader theme on their stock-based comp? John, throw up this chart. Like, as somebody who's like actually like an investor, like what do you
How bad do you want me to make your comment section?
like when you see shit like this? What do you think?
Let's for the
Okay.
audience.
All right, I got it.
In Q3 2020, stock-based compensation for Coinbase was $16 million.
And I think they had 1,500 employees around something like they. So now in the last 12 months, they hired 3,000 people. As not that they could have predicted this, but retail transactions fell 58% quarter over quarter, maybe year over year. Now in the last quarter, $352 million in stock-based comp. As an investor, what do you think? The mic is yours.
I think there was a
Mike is yours.
there was a rap banger in the early 2000s called "It's Going Down," and I think that's what's about to happen. No, I mean they're in a very rough spot. I mean they are in crypto is in a really really rough place because you've had kind of a branching out into the store of value type stuff. You've had the application related stuff. Then you've got collectibles, other things like that, and then you've had DeFi. And I think DeFi is over. There could be like a new phoenix from the ashes here, but a lot of this stuff were just straight up Ponzi schemes. You have Sam Bankman-Fried, who's the king, going on Joe Weisfeld podcast and just openly being like, "Oh yeah, it's a Ponzi scheme. You know how this ends."
I still can't believe that.
I mean,
I admire the honesty.
You're talking about several of the major categories here. getting completely obliterated. I think you're going to have it, not a crypto winner, a crypto nuclear winner, because there's so much nonsense. I mean, I always try to, I'm naturally very skeptical, and when I hear the pitches, my skin crawls, and so I'm like, all right, I have to listen to this because I'm going to have a bias and not listen. And then I go talk to these people, and these people don't know anything about anything.
What do you mean these people?
Yeah. What do you mean these people?
There's this meme of all these smart people go to work in crypto. Okay? Bullshit. There's a lot of people who are like random middle managers at random companies. Yes, there's a small cohort of really elite coders, and they're running arbitrage operations and just ripping people's throats out, and they don't even know it.
Right.
There's some very sophisticated, really, really smart people that's 0.25% of the traders in this market. And then there's a bunch of people who don't know anything about anything. They don't know how computers work. They don't know how code works. They have no idea what the a blockchain is. They don't know how, they don't know how a bank account works. They're flocking there
because that's where the money is.
Right. It's been free money.
Yeah.
You go in and it prints it, and then you get to join this cult of people that makes you feel very welcome if you're inside it and not welcome if you're outside it. And they tell you you're smarter than everyone else. And they tell you that the whole world is a scam. And you know what? The world kind of is a scam because it's this thing called society where we're all going to
we all agreed on the scam.
We're all going to agree, right? Yeah, because it works,
right?
And these things don't work. And I mean, I remember I was going to crypto conferences in 2015, 16. We've done this a couple, not to brag, and they've got bagel. There's no usable application. There's nothing, and I'm tired of hearing about all these smart people going in. There's absolutely nothing usable coming out of this space.
Well, the usable stuff is for crypto people to do crypto things,
right?
But there's been an argument that that's how everything starts. Like, in other words, if you went to a computing trade show in 1980, everybody there was building things for other computer enthusiasts.
Right.
Steve Jobs had a booth, but nobody gave a shit what he was talking about. Because they were building things for themselves, which is how a lot of things do start.
Yeah, I think there are people who are building very legitimate technology in the crypto space. But my point is that if you were to take the top 100,000 posts about crypto on social media.
Oh, well, I'm going to skip those.
There are maybe 6 that have to do with something that is legitimately technologically important. And the other thing I would say is when I talk to serious family offices, serious investors who are really trying to do the work, the things that they're investing in, I've never heard of in public from all these crypto people.
Like what?
I don't think I'm allowed to say.
Fair.
But because they're all like
Cold Fusion.
Yeah, Cold Fusion, perpetual motion machines, that type of stuff. But there is so much capital that has to be destroyed, and it's sucking up a ridiculous amount of resources. I mean, it's incredibly damaging the environment. I think when you're looking at store of value, you're looking at some of I think NFTs in some form are going to exist. They're not going to be $500,000 or $1 million for these things. Like this, it's just not going to happen. But there's the major cohorts of this stuff, and the majority of the participants are going to zero, and I think it's really messed up. And I have a personal ethical issue with how many people. I had a friend from college who started this Facebook group where he was promoting people to go into crypto. And it wasn't like Bitcoin.
Promoting people to go into his coins?
I don't know what his relationship was, but it was all these kind of sketchy things I'd never heard of that didn't have serious developer bases and all this other stuff. And he got 50,000 people in this group.
Yeah.
And I was like...
Because a lottery.
And I went and I posted and I said, hey... and he kept referencing me being like, my boy knows about finance and he likes this. And I'm like, hold on. We had a beer once at a tailgate.
Photoshopping you into the T-shirt.
Right. Something like that. Yeah. And I just went and I posted, I said, hey guys, this stuff's really, really speculative. Please, please, please only put money that you can afford to go to zero, because understand that this stuff 50% of the time at least is going to zero. And also, if you're making a ton of money, take some off the table. Please. They blocked me from the group, and I got 50 hate emails from people about how I was spreading FUD and trying to destroy all this stuff.
Yeah, now, you can't do that. It's a party foul.
Right. Well,
you can't make people think twice. This stuff doesn't work if somebody thinks twice. And what I mean by that is when someone's I'm building this thing, well, is it a bridge to nowhere? Is it a monorail into the side of a mountain? Or is this something that people really need that are not crypto people? The answer is always well, eventually we'll figure that part out. And I accept that somebody will figure some things out. But I just don't have a tangible example. I had a debate with somebody ad hoc, not my idea.
Right.
I spoke at Young President's Organization.
Okay.
You ever been to a YPO function?
I actually went to one, yeah.
Okay, so I went to one and I was the speaker. And I made some comment like, somebody was like, do I allocate to crypto? And I was like, well, yeah, if you think somebody else is going to come buy it from you higher, then
Right.
yes, it works. But if you think like it's doing anything in the economy, so far, no. And this kid flipped out because he's
Right.
a crypto kid.
Right.
So he's like, dude, the SWIFT system, banking system is being moved onto the blockchain. I'm like, oh, I missed that article in The Economist.
Right.
When? And then, of course, Barry Ritholtz is next to me. He goes, yeah, I'm moving to Monaco. Like, you know,
Right.
it's a lot of things that are going to happen,
Right.
but they just haven't happened yet. I think when you see prices do what they've done, it makes a lot of people start to second guess.
All right, so
all their original
Dan's
opinions.
super
anyway.
bullish on crypto. We get it, but in terms of
So go to Coinbase for a second. Okay.
stock-based comp, what do you see? What do you think?
Right. So, one second. So, my whole point is when you're looking at like a sector, right? Sometimes what happens when you're looking at a sector is you find a business you really like, and then the thing just keeps going down. It gets obliterated, and you're like, "What the hell is going on?" And what you miss, especially, and I remember like when I was in college and I was looking at stocks, this would happen. You miss is that it's the one good company among 500 terrible companies.
Yeah.
And so when those companies get obliterated, your stock's not going up unless it gets bought out. Like otherwise, it's dead. So I think crypto has that problem right now. There's too much dead weight. There's too much nonsense, and there's a massive misallocation of resources, even if you were bullish on crypto. So I think that's really, really bad. So I think, and the number of participants, my point about the noise versus serious people is the vast majority of participants, the retail traders, are the people that are going to get smoked. And so I think they have a top line issue in terms of number of customers and volume, just because their bankrolls are getting obliterated.
And those people don't come back.
No, and once
But Coinbase's financials were so good when it came public,
Right.
Because the margins for trading this stuff,
That's point two.
with retail people,
right.
It's like 300 bips, whatever it was.
But
think
it's
it's
an
four- I think it's
artifact
400 or
of the
500.
but it's an artifact of the pandemic.
Yeah.
You had people had nothing to do with themselves other than trade things that they didn't understand. So
Right.
so even if you're bullish on crypto, you can't be bullish on crypto and then also think that the crowd is going to stay that naive.
That's what Chat42069 thinks.
Come on. Like eventually, if this is really going to be its own ecosystem, then professionals going to step in, and you're not getting 20% on trades anymore.
Right. I mean, I know CTAs used to use this term. I don't know if other firms do it. They used to call it a round turn, like how much are you making on the guy going in and out of the trade. And, so they were making at one point north of 10% plus, plus whatever they were making on crossing the bid-ask spread. So these were insane profit margins on a lot of people who had nothing else to do. Now you have all of those drivers going against them.
And then Citadel.
And you have Citadel and FTX coming in.
Right. Say goodbye to whatever your
Right.
margins were.
But no, it's interesting. Everybody was saying that. And then like it happened really quick.
Right.
That they were
Everybody was saying what?
Well, so I can
that
say
their
that.
margins were going to get mushed.
Yeah. So one thing I can say, I think, is that several of the smarter large money investors I know, I don't know, 6-9 months ago, I can't remember.
Nice.
Time is a flat circle. I'm sitting there. What do you think of crypto? And they were like, "Well, we're going to back FTX and some similar things like that." And I'm like, "Well, what's the thesis?" And they're like, "Oh, they're just going to nuke Coinbase from orbit."
Were you worried? Were you worried last week during the stablecoin run that this stuff had gotten big enough to be systemic?
No.
And that it would be connected to the mainstream assets that you own for clients or whatever? Like, did you have that concern?
So
If Bitcoin went to zero, would that have a ripple or a splash?
No. Obviously. Come on.
No, so my fund is set up with kind of a very explicit design where I'm saying, look, I buy things that have cash flow. I buy businesses where if they go down, the company will come out and will buy back a ton of stock. Earnings will be higher next year. Relatively defensive, safe, like really boring stuff.
I only buy stocks that go up, so I'm with you.
I need to figure out how to do that. But so my stuff tends to be pretty volatile, but it tends to not be correlated with the market. And so it's for me, if the market just pukes 5% on a random day, it's usually a relatively good thing because I can come in and I go, okay, like, it's an
I think
opportunity.
the fear
for me.
was, what if we discover that JP Morgan's prop traders or, Fidelity, somebody that's really systemically important,
Right.
had a lot of leverage and or exposure to something that blew up, and that would set off a chain reaction. Like that was the way people were talking that one day. We're 5 days removed from that. Crypto was $3 trillion or whatever the hell it was.
No, it's like 1.2.
Fine. It's much smaller now. How big was subprime? Now, I don't think this is as ingrained in the real financial system as mortgages, but I'm saying like that was the first time that I think a lot of people really were forced to ask themselves, am I in any way connected to one of these Ponzi's that's blowing up?
Yeah, I just didn't see the potential for. I saw, I think there's a big correlation between, and you can kind of see it. There's a big correlation between like ARK and the ARK related stocks and the retail stocks and Ether and Bitcoin.
Yeah, same owners, in other words.
Yeah, same owners, same traders. That stuff is pretty correlated. It tends to be stuff I'm short. Like, okay, like it's fine for me. But there's no way that, a stable coin run by a lunatic is going to sink JP Morgan.
What's your take on this? I'm not on Twitter, so I didn't even know this person existed till last week. So my opinion on this is not that important. But I'm curious, as an extremely online person, what's your take on Do Kwon? Is he a crook or just an asshole?
Yes.
Okay.
I mean, there are.
I feel like he lost his entire net worth in this, but what the hell do I know?
You're gonna hear the same story like 50 times in the next like 6 months, where you're gonna have people where a year ago they're saying, I am a coder of prodigious origin, I'm a math genius, I can't even explain to you how smart what I'm doing is, and then
you're gonna play dumb,
and then they're gonna say, oh, I didn't realize that this is clearly mathematically a Ponzi scheme.
Yeah,
and
it's a benevolent Ponzi scheme,
right? And
I think they need to put the system on trial
again. Yes, exactly.
They need to explain why the dollar is the world's biggest Ponzi scheme,
right?
Followed by Social Security,
right?
That's the only way out of this, for some of these people.
And the difference between the crypto Ponzi scheme and the dollar Ponzi scheme is that the entity that backs the dollar can nuke our species out of existence.
That's right.
And the people behind the stable coins can tweet really mean things at you. And it's similar in a lot of ways.
So he's now apologizing to people, I'm told, on Twitter, off Twitter. He's calling people. I think
but allegedly there's been like 20-something suicides. I mean, really real.
Yeah, I don't want to make light of this. I don't want to make light of this at all. Part of me feels like it would be bullish for crypto if there were like some high-profile jailings. Yes. Because that's really how you show that you have to be responsible with what you put out into the world. Right. So I don't know anything about this particular case, but we really haven't seen high-profile crypto penalties like that. We've seen very low-level ICOs where people have gone to jail, but nobody knows who they are.
This is one of the topics that has been popular on Twitter at different points is the issue around accredited investor rules. And so the accredited investor rules basically say, they're misinterpreted. What they essentially say is if you have over a certain amount of money, you're going to basically waive a lot of your protections. You're a big boy. Yeah. Like you understand that this thing is levered or crazy or whatever. And there's an argument that they're ridiculous and everybody should do whatever they want. And the commonly cited example is, well, gambling's legal, so why? And I agree with that sentiment. But the problem is the people who want this stuff repealed, the extent to which these guys have weaponized recruiting retail investors at this scale using social media and stuff like this, it's really unprecedented. There's different versions of it. It's existed for a long time, but I mean, you can go back and read Reminiscence of a Stock Operator, and you read about the exact same things happening in crypto happening in the 1880s.
Well, Buffett did this. He weaponized it. No, I'm only kidding.
Right,
they've been doing your point is very important. They've been doing this forever. They were selling fraudulent shares in canals and railroads in the 1800s, and they used the newspapers and they used telegraphs. They were selling penny stocks over the phone.
John Law,
but you could not reach 10 million people around the world with a 140 character tweet, and literally recruit billions of dollars into a fraud, up until 3 years ago.
Yeah, and it wasn't nearly as controllable, and there's a bunch of other problems. And again, look, if people want to speculate, that's not the issue. The issue is what happens every time is then something like what just happened happens. People kill themselves. People go broke. People starve. Terrible things happen. And then people go bang on the doors of government.
Where were you?
And where were you? What the hell?
Yeah.
And the joke is always that regulators are archaeologists, not detectives. And that's what we're seeing happening again. But to have it happen at the same time where everything else is melting down.
Here's your question though: like a regulator can stop a traditional Wall Street fraud in progress,
right?
And issue a cease and desist.
They don't, but they could.
No, I've seen versions where they have, where they'll say 3 people just got robbed. 2 of them complained to us.
Right. Oh, yeah.
There are
they do
20 ongoing customers who are not aware that this is a scam, and we're going to put a stop to it right now. We're freezing bank accounts.
Yeah.
And we're putting out we're doing a press conference.
Oh, they do a pretty good job of that stuff. I'm talking about
how would you stop something like this in progress if you're a regulator? Congress hasn't even said you have jurisdiction over this.
That's the problem.
It's a mess.
But this one's a real mess because not only that, but the amount of money that the crypto guys are putting into lobbying is immense.
Yeah.
I mean, there's hundreds of millions of dollars going to,
both parties now.
Both parties. And there has to be regulation or this is going to end really horrifically.
They do seem to be calling for regulation. The thing is they want to have a hand in helping to write it.
Right. I think what's happening is you're seeing some players get into these really dominant strategic positions. They're going to let's say theoretically just beat the shit out of Coinbase. And then once they're in kind of a pseudo oligopolistic monopolist position, they go, okay, now we're ready for regulation. Right. And then they're going to own the market. And it's really, really smart. But what is concerning and important is that we get to that point without a ton of people losing their life savings and ending up in these horrible situations.
This is less horrific news.
There we go.
So shipments of smartphones within China fell 40% year over year. And Apple is getting, for the first time in quite a while, Apple is getting the shit kicked out of it. And I feel like this has ramifications.
I said that the market can't bottom until Apple and a couple of other stocks stop selling off. Apple just started selling off.
Yeah.
Yeah.
I know individual stocks can bottom, sectors can bottom, but the S&P can't. Mathematically.
It's a big slice, right? So
I don't see a way where the S&P 500 stops going down and recovers, while the FANG stocks lose another 5 multiple points.
Dan, talk about this. Walmart got clocked again today, so did Target. Modest Proposal tweeted, yesterday a 0.73 beta stock fell 12%. Today a 0.8 beta stock has fallen 25%. That is mildly disruptive to risk parameters.
Yeah.
Talk about this.
I mean, what I don't know what he said is basically obvious, but look,
it's blowing models up.
Yeah, well, you're having a situation where
because if you're looking for safety, you're overweight low beta stocks, and they're acting like ARK stocks. Yeah.
Well, you're just one of the things you're going to do if you're running a risk model, right, is you're going to take a stock or a market or whatever it is, and you're going to go through the historical data, and you're going to see how volatile is this thing over different windows. You're going to check how it correlates. You're going to look at what the options did and what the old options did, what the new options did, all this other stuff. And you're going to try to figure out, okay, what does this thing normally do? And then what does this thing do under weirder scenarios, right? And so you're going to kind of try to
stress test.
Yeah, stress test it, figure out what's going on.
So what do we call this?
And so this is just a non-stable kind of distribution. This is something where, and so basically the thing that makes people break the glass and go, holy shit, I'm out, is when you start to see things move way outside of your models really fast. Because if something creeps, you can sort of tweak things.
Nothing like this.
But something gaps outside of your, and so this is like
so
the first scene.
A consumer staple stock blowing up.
So both of these, Walmart and Target, both of them in the same week had their worst day since 1987.
Right.
Literally Black Monday.
Right.
In the same week.
Yeah.
Yeah, and this is like the first or second scene in Margin Call, if you guys remember the movie, right? So they're like, the guy figures out the model, and they're
he calls his boss.
Yeah, he goes, "What is this?"
Yeah,
and they go, and they go, "What does this mean?" And they're like, "This is where it's supposed to be, and now it's here." And they're like, "And that could happen." And they're like, "No, it happened last week." And then they're like, "Oh shit!" And then starts everything.
Paul Bettany is very concerned.
Right? Yeah, exactly.
He's extremely British about it all.
Yeah, and it's kind of like that. But part of what's happening right now in the market is, the market. I think especially if you're a retail investor, or even if you're, most people should think about the market as kind of being a amorphous sea of capital doing things, but it's not.
Most people don't know what the word amorphous means.
It's just a big bucket of water, and it's not important to pay attention to the individual water molecules or whatever. But it's not. It's actually discrete actors. It's individual firms, people and it's pretty concentrated. And so when you have a period like the last 3 or 4 weeks, you're having a lot of like big funds that normally would step in when something's down 5% and buy some.
Melvin.
People that would provide liquidity is always the euphemism for it. You Melvin being one.
People like Dotcom would normally
People like Dotcom step in and save Walmart. Yes, right, yeah. But you're having a lot of the largest hedge funds, with the exception of the multi-managers, are down 30, 40, 50, bearish. 60%.
Yeah.
Well, they don't have any bankroll. They have no fire. They have no more bullets to put in the gun and shoot at stuff. They have to play to survive right now. And also, okay, you're down 60% and you own – the thing is, a lot of these guys, they own like 9% of a company. So if they sell a share and that gets out in the market, people go, holy shit, Tiger's selling this.
The bankroll is the companies themselves right now.
I'm just talking about in the
buybacks?
market.
Yeah, we're going to do a trillion in buybacks in the next 12 months.
Right.
But not all companies are going to participate in that.
Right, but the question is like immediately after like let's say Target reports, who is there to step in and buy Target shares in this market environment?
Jeff Mackey.
Jerome Powell.
Literally just Jeff Mackey.
Yeah.
I mean, there's nobody I know who either people are not in a rush, as we were talking about, or they literally don't have the money. And even if they wanted to get the money, they might have to go, if there's a headline that like a Tiger Cub is selling one of their big holdings, that stock's going to get smashed. So they can't sell that to get cash to go to something else. Do you think they want to lever up their portfolio?
I was thinking of that. I thought was funny. Not really funny. Tragically funny. You picture like, and there's thousands of these guys out there. You picture like the guy who runs the family office,
right?
For the family who founded like Walmart's a bad example because we know who they are,
right?
But like just one of these companies that loses 30% in a week,
right?
And you're like running the family office, and the whole thing is reliant on the shares of that company not doing what they just did. It's like, all right, I guess we're not going to have the picnic. I don't think we're going to do the Easter egg roll this year on the front lawn.
Thankfully, I don't think most family offices are actively levered off of their stock. Although a lot of like tech people,
I think they mostly are.
Well, speaking of leverage, John, can we throw up this options chart? Dan Hide Not Slide did this thing on like option industry volumes, and this has to be like moving shit.
We had a technical difficulty.
Yeah.
What is that?
Oh yeah. No, so I mean that really
option industry volumes.
My point there is that the active manager is basically all in the penalty box right now, and passive doesn't step in like when Target goes down 20% in the short term, and they can't come back they can't buy back out of that. So in these shorter term windows, you have these crazy moves because
there we go.
People in my seat can't really play.
So what is this? This is just overall trading volume by month of options.
Yep.
I can't believe it peaked in January of 2021.
But so what? But so what? Look how high it still is compared to pre-pandemic. It's twice the size.
It could be different types of options now than it was 18 months ago, though. No,
it's not like just speculative buying options.
That's what I mean.
That's the thing, right?
This could be a lot of covered calls now. It's the same volume, but we don't have a breakdown of what kind of options activity. So
yeah, I mean, there's an enormous. I mean, Mike Green talks about this a lot, and there's Ben Eifert.
There's a lot of covered calls ETF strategies that now have $10 billion.
Yeah.
So all of this market structure stuff, like it's not bullshit.
Right. No,
it's not bullshit. Also, because think about how many algorithmic trades are being done at extremes, pushing those extremes further.
And so when you see Target down 25%, what does that do to these models? Like literally.
Well, I mean, the thing that a lot of quants are doing, right, is I think there's a lot of different types of quants that are doing a lot of different things, but I think there's intent ascribed to what quants are doing that isn't necessarily present in a lot of these. A lot of what these guys are doing is they're going, okay, you guys care about what this business is. I don't give a shit about that. All right, let's talk about what the stock is. Okay, the stock's in the S&P 500. So every time somebody trades an S&P 500 future or an ETF or something like that, there's look-through volume. Anytime somebody trades an option on that index or trades an option on the stock or trades an option on the sector ETF, there's all these other securities that anytime they trade, there's some butterfly effect impact on that stock. And so when you have a window, and so from time to time, that all of a sudden is going to massively overwhelm what anything else can do, especially because basically you think about it, there's a bunch of people who are playing for different reasons. If the active guys go, I need to figure out what happened in this quarter, so we're not going to trade, and the passive guys don't have views, then you're left with all that stuff. And if there's a bunch of, you could go gamma or whatever, if there's a bunch of selling pressure, there's no bids.
You see a stock go up 5% on Monday, down 5% on Tuesday, up 5% on Wednesday.
That's what Coinbase is doing right now.
Yeah, intuitively there are no human beings passing judgment on that company.
Right.
That's all mechanics, all weird shit going on both sides of the ball.
Right.
And when you're an investor and you're logging into your Morgan Stanley account or whatever, you're watching that, there is a temptation to just be like, this is stupid. Why am I even doing this? And I don't think we're fully there yet, but I think that's the kind of thing that leads to capitulation. It doesn't just have to be down stocks. It could be that up and down pattern that seems random and meaningless. And people just say, I don't want anything to do with this anymore.
This is the scariest thing in markets right now is very few people who are trading right now have ever been through extended periods of pain. And not even like it going down, just every time it's been bad since,
V-shape
2013, 11. Yeah, it's been bad for like maybe 6 weeks max, and then we just rip out. And so everybody's been trained to double down, buy all the dips. And
we call that a martingale strategy around here.
Yeah, there we go.
No. But you can, right. So now you can have bottoms and bounces that never get back to the high.
Right.
And then they
Lower
roll
highs.
back over.
Lower highs.
Yeah. Nothing will kill sentiment like that.
Right.
Is what
so
you're
now,
saying.
there's like, a lot of people
By the way, I'm about to kill myself. So I'm going to open this up.
Yeah,
there's there's a lot of people.
We're going to get to the bullish stuff in a minute.
Yeah. But there's a lot of people,
No, we're not.
who are around in 2000 where when they talk about trading, they say things like, I'm going to put some on, I'm taking a little off here, da-da-da. And there's younger guys who are like, what is this guy talking about? Like, why would you do that? And now it's like, now people are like, you know what? Maybe the take half off thing, like there's a reason why these chartists do all this stuff.
You know what I did in the last week? You
Take a little off?
Yeah, I bought nothing. I took the stocks that are down the most, that bounced the most,
Right.
and I sold half. I have some big, huge, like they're not big positions. They don't matter to me in real life, but they looked so horrendous at the lows, and then all of a sudden they went up 20%, 25%.
So you know what we haven't seen yet? Earnings estimates coming down, and these have to get cut. Look at these. Look at the consensus analyst estimates. Yeah, I'm going to say no.
Well, hold on. They're saying consensus analyst estimate as of April 30th for the S&P 500 earnings this year was $275. I'll take the under on that.
I mean, these have to come down. Now, the good news is, to the extent that there is good news, we got HSBC cutting their S&P 500 year-end target to 4450 from 4900. We have Deutsche coming out from 4750 down from 5250.
Every major Wall Street strategist is now a 35% chance of recession.
We got it.
Cheers.
Yeah, right. We got
every one of them. So you're telling me there's a chance?
We have to get like analysts like saying, you know what? Maybe Apple. Maybe we're gonna cut it to a hold.
It's coming. It's all starting.
I actually do have like a bullish take whenever it's appropriate to like
Now-
take us out of the
Wait,
tailspin.
here's my bullish take.
Now would be good.
Here's my bullish take. So I was writing. So why is everyone bearish? Why are sentiment indicators literally through the floor?
Mostly because of this show.
Because everybody,
So this
Duncan, you
episode.
with me on
because
that?
everybody knows a recession is coming. We're not getting blindsided. Everybody sees the train and we're standing on the track. And so hopefully, like the bullish case is, the monster is never as scary as you think it is in the movies. And so we're front running the anticipation of it being really bad.
Okay.
And if it's not as bad as we think it is, that could be a nice setup.
Why are you jinxing us like this?
It's going to get bad. The monster's, it's going to be the scariest monster of all time.
Do you have a date you're calling the recession
No.
to start?
The reason everyone is casually saying recession is because nobody is insecure about their job. Everyone knows they can get a new job tomorrow.
Right. Nobody
All they
says
hear
that.
about from normal people don't know the stats that we just cited before: 11 million open jobs.
No, but
5
they
million
feel
jobs.
themselves getting poorer every time they go to Walmart.
But wait a minute. But they're not worried about their employment. I don't think. That's why I think people are like, yeah, there's gonna be a recession later this year. First of all, a lot of small businesses are rooting for one because, quite frankly, they can't get supplies, they can't get this, they can't hire people.
Really dumb to root for one if you are a small business.
I agree.
Yeah, I know what you mean.
I agree, but I talk to construction guys, landscaping guys. They're like, I can't take it anymore.
I talk to construction guys.
I do.
Yeah, okay.
I really do.
Yeah, name one.
You've actually used them in your home.
Kevin?
Yeah.
You don't talk to Kevin.
Dude, I talk to Kevin all the time. And by the way, think about somebody that can't hire people,
Yeah.
and they have to continue to spend more for everything that they have to purchase. Wouldn't they want not a recession? Wouldn't they want like a stop?
They want a
to
soft
the upward
landing.
trend.
That's-
They want a soft
Right.
landing.
What's bullish? Let's get bullish.
Okay. Let's talk about so we're in this weird place where bad might be good.
That's what I'm trying to say, but
yeah.
you're laughing. Literally, bad
Yeah,
might be good.
Bad might be good here. Okay, so let's first let's go darker. Okay, the doomsday scenario is we have like a 1970s style inflation, and we try to hike rates, and it doesn't do anything, and like the dollar collapses.
That's doomsday. Yeah,
and it gets and then probably worse things happen. But that's the really bad thing. In the past,
35% chance.
Yeah, put a number on it.
1 in 3.
The good thing, perversely, is in the past when there have been attempts to tighten financial conditions, you have not seen anywhere near as fast of a response in the economy as we're seeing right now.
We're tightening.
We're tightening. I mean, Bank of America put out a great credit card data panel where it showed, basically year-over-year comps going from plus 15 to kind of minus 2 across like 17 different sectors. Freight prices are down. Computer chip prices are down. It's kind of sector by sector you're going on there, and things are coming in. Now, it's not yet happening for gasoline, obviously, and that's one that really messes with people's heads because they've been kind of trained to think it's
wages.
Right, and wages. But what we're seeing now is we're seeing the beginning of a loosening of the labor market. And so in a weird way, like the things that sort of led inflation on the way up are already rolling or rolled over. Used cars, all these other things coming in. And yeah, they're not down that much, but if things continue as they're going right now, we could get out of this inflation problem, which is the reason we need tighten, which is the reason everything needs to cool off. We're choosing to put the patient in a coma here because otherwise the patient's going to get a fever and die. So
you don't have to wait. You don't have to wait every month for a CPI report.
Right.
You can just watch commodities every day.
All right, so keep going.
Yeah. So and there's this weird dynamic right now where government, the official economic data that's coming out has all sorts of weird different lags, and so there's going to be some scaring the shit out of people processes as different data comes in or out of that. And also there's going to be all this weird comparative stuff happening. But you also got to remember the market always bottoms 6-9 months before the recession's fully clear.
Nice.
Right? So we're going into a period where I think we're seeing deceleration. I think we're going to continue to see that. We do have a shortage in commodities, but we could see the kind of real-time inflation data come off a lot faster than people think. Particularly if the economy keeps decelerating like this. And right now there's this weird place where everybody's kind of trying to talk about, next year is going to be super rough. I think we're tightening very quickly. I think everything's coming off really, really quickly. I think there's a scenario on the table where by the time we get to sometime in Q3, Q4, you're starting to see a lot of things kind of rebalance, unfortunately because the economy slowed down. But the second this inflation thing isn't a runaway train, then we're kind of done with this.
Here's the problem, though. It's the mix shift of it.
Yeah.
Because it's not going to happen in rents, and it's not going to happen in wages. Wages will stop going up, but they're not going back down the way used cars have. Like, used car prices could roll over. Wage growth doesn't roll over. It sticks. That's number one, and that's a really big part of this whole thing. And the real estate shortage, the rental prices, again, that's the kind of thing that tends to stick. Arguably, it's a bullish argument for REITs. They pass along costs, and the costs stay up.
The concern is, the question is, are we talking about absolute price level or are we talking about rate of change?
We're talking about rate of change.
We're talking about rate of change.
Right, but politicians are talking about absolute price level. Can you believe the price of this? Can you believe the price of that?
That confusion is where a lot of the risk of policy mistakes comes in, I think, is that when people talk about inflation, a lot of these policies, they're not talking about the same thing at all.
That's right.
Gas at $5 is not a big problem if it stays at $5. If it's $5.50 next month, $6.57, that's a problem. Because when people start seeing that every time they go out of their house, they go, holy shit, this is never going to stop. I got to pull spending back. And then you end up in this really nasty
But then you also have these sideshows that are not relevant economically, but culturally extremely important, like baby formula.
Right.
And this is being used as a cudgel against Joe Biden.
Right.
Joe Biden robbed your baby of formula, his policies. That's a sideshow. The price or scarcity of baby formula is not an input to CPI. It's not important, but it's really important to the mindset and sentiment.
Right.
It's extremely important because that's the context that people think they're waking up to the world in each morning.
Right.
A world where their niece can't get baby formula. Right. That dominates their thinking. And I think enough of that kind of mass sentiment is now weighing on everything from stock prices to you name it.
Well, as we know, the market will bottom with horrific news.
Yes.
And it will rally on even less horrific news, but still horrific news.
Let's pause for a second. All right, we just had a global pandemic that humanity just collectively just took on the jaw, walked through, and then won the fight in a knockout. And now we're paying for it a little bit. I still think the trade's good. I think you take it all day.
Yep.
The problems we're dealing with right now.
What, you take the inflation having lost 1 million Americans.
Yeah, I mean, we could have done better. But
this is a result of
Could've been way worse, too.
stimulus and monetary policy. If we did nothing,
information at the time.
Right.
And that's another thing.
Although we did go too far. Josh talking about this the other day. The stimulus package in March 21, the 1 point whatever trillion dollars it was, that was a bit much.
Almost entirely political.
Yeah.
No economic reason for that.
Practical. I think given information at the time, practical constraints and all of that.
The pandemic response was appropriate.
Yeah. Right. I mean, I think
1.3 trillion in March of 21 with the NASDAQ at a record high.
Yeah, that one was ridiculous.
What are we doing?
But my point is, I think the problems we're dealing with right now, by and large, with the exception of commodities, where we have we needed. I don't really think it's ESG. I think it's more that returns were horrible and people lost so much money in oil and gas and other stuff that an ESG kind of gave them a great excuse to not invest in that.
Underinvest.
But we have to
if Russia didn't invade Ukraine at the end of February,
that would have really helped.
Would the inflation, the transitory inflation have been a little bit more transitory? Would the Fed have looked smarter?
I think we still, yes, we would have. I think we'd be in a better position.
Oil was 70.
We'd still have a big problem.
Okay.
It would just been more of a frog boiling, slow burn thing. But
so Putin really did win when you think about it.
Oh my gosh.
I'm just saying.
I just think that when you look at the problem set we're dealing with right now, every problem we're dealing with is a problem that humanity has solved many times.
Yeah.
It's not necessarily fun. Sometimes it takes a while. Like, we're going to solve all of these problems. And so, like, the main point, I realize I've been like super bearish and critical on this, and I tried not to be most of the time. But, there isn't a rush. You have a time right now to go research, make a plan. This is the time to be a long-term investor and to think 5 or 10 years out. Not when stocks are at 50 times sales.
Could not agree more.
Right? And I got so sick of hearing that. Everybody's like, my biggest mistakes are errors of omission and da-da-da. No, shut up. That's nonsense. It's ridiculous.
Oh, the stock I didn't buy that doubled?
That was everybody saying, my biggest mistake as an investor is I missed
Solana.
I missed that, or I sold too early.
You know what's bullish? You know what's bullish?
No.
The exogenous shock is never right. This is a normal market cycle.
Yes.
We know we're working our way through the cycle.
There's a playbook for this.
Right.
We know how this goes.
We will get out of it.
You can literally, there are books written on exactly how this went. There's pretty reliable options. You just got to ignore the doomsday. The dollar's not collapsing. Like, we're not going to nuclear war.
Well, this is a truism always. You can
buy the missiles.
No, you must tune out the most hysterical, most extreme version of things. Right. And the people who make their money propagating those scenarios. Like, that's a truism or at all times. Whoever is the most extreme is the most dangerous to your mental
There will
health.
be people saying the market's going to zero.
Right, and it's not. And this is all going to pass. And the reality is, right now, if you spend the summer, all right, summer things generally tend to calm down a little bit. It doesn't mean things are going up, but make a plan, have a view on what you actually want to own for the next 5 or 10 years. You're going to get some great prices. And one of the things I always tell people when they're asking me, like, hey, gosh, should I do my brokerage account or whatever? I'm like, learn the companies.
Should I do my brokerage account?
I have a bunch of people call me and they're like, hey, I'm friends with your sister and I want to do
I heard
stocks.
you're a hedge fund manager.
Right.
What do you think of Intel?
Yeah. Or like, hey, I'm thinking about getting into algorithmic trading. I'm like, first of all, you're not a coder. But you got to pick your asset allocation, pick your stocks, pick your buy levels. If you think you're going to decide a good buy price in the moment, no. You got to go through, do the work right now, pick your price levels.
Have a time horizon.
And understand that
and have a rich family.
Hey, speaking of no rush,
and be born into a real estate billionaire family.
My friend texted me yesterday. I know you don't love giving advice, but I got an email from my advisor. He wants to buy NVIDIA, Amazon, and Shopify.
Bye.
Market is wild, I know. I was never big into stocks, but I wanted to get your take.
Hey, do you care about executive comp and pay packages? Do you think that's a silver line? Let me set this up. This is kind of a big story this week.
I actually have I have a take.
All right, I want to hear it. Intel executive comp package rejected. Gelsinger is the new CEO. He just took over in February of 2021. So, of course, he received a compensation package worth $179 million last year.
Yeah, it's before taxes.
Which
though.
makes perfect sense. That's true.
Right.
The compensation included $1 million in salary, $1.75 million in bonus, and then $140 million in stock awards, and then another $30 million in option awards, which I wouldn't take that job for $1 less, to be honest.
How about Jamie Dimon? They slapped him down.
Well, wait, back to Intel. In 2021, 16 companies had executive pay packages rejected by shareholders, so almost none. Now, all of a sudden,
That's going on.
new hot trend alert.
Right.
Only 31% of investors backed Jamie Dimon making, what, $50 million?
John, throw up this chart.
So 70%.
We're looking at
rejected it.
shareholder support at JP Morgan. What's AGMs?
Annual general meeting.
Okay, since 2009. Next chart, please.
So they basically rubber stamp this every year. It's
Yeah.
90% approval. This year it's 30% approval for that pay package. So he might only make like $40 million, which I don't know what you expect this guy to do. But all right, what's your take here?
I'm a fan of Jamie's, but
So am I.
yeah,
I'm a shareholder. I would have given him the money, by the way.
right. I mean, one of the things that the way we look at it is we look at how the executive team and really the whole team is being compensated relative to the elements in the business they can control. And so if
I like that. I like
right?
that. Yeah.
And so if you happen to be the CEO of a penny stock like copper miner and copper prices are going nuts and you're like, I deserve to get call options on all the stock. No. Like, I'm sorry. That just doesn't make any sense because there's nothing you're doing that is driving that.
Yeah, but I took the risk in going into the copper mining industry. Don't
Well,
I get
that's-
something for that?
You probably just were dumb. But if you took the job, like there are scenarios where somebody comes in, so what we look at a lot of times is when you have a company that we think has been mismanaged and then you have a really good manager comes in. And sometimes what they're saying is, I'm going to fix this company. We're going to do all this other stuff. And I think copper's about to go on a run. And as my pay, I don't want a lot of cash comp, but I want to get super paid on stock if the stock works and they're calling their shot. And I love situations like that because I'm not aligned with management. Management is aligned in also making a very explicit bet that my thesis is the same as his. We're all super aligned. I like that. For large corporates, some of these guys actually are adding a lot of value. Actually, the only person that can do what they can do. I don't have a strong view on any of those individuals. It is ridiculous for everybody to come out now and be offended by the comp.
But they
because the
only
comp's been
care.
offended.
But
Right.
they only care when they are losing money.
Right.
Which is my point.
Right.
Perhaps this is a silver lining for shareholders generally, that somebody is now paying attention to this. But they would only pay attention in a down market. In a bull market, everybody's making money. Nobody's
Right.
looking at what anyone else is doing, right?
Yeah, I mean, just as an example, like when I go talk to management teams, one of the questions I ask is, what is your capital allocation plan? So you guys have profits coming from the business. What are you going to do with
the money?
them? How do you think about
Right.
that? Do you have like a formula? Do you have how does that work? And I'll tell you, like 80+% of public listed companies have nothing. Nothing.
Not even a stock answer that they can give you?
It's, we consider a lot of bullshit. Nothing. And so when I look at that, I'm like, all right, none of these institutional shareholders that have all this voting power, none of these people are going in and enforcing just like basic accountability, basic blocking and tackling, basic planning, which is why when there's these market crises, you see these companies make these horrible decisions because they didn't have a plan going in and then they freak out at the bottom. And so, yeah, I mean, these people are probably being overpaid, but I think it's a little bit of just like a ridiculous theater show for shareholders, certain shareholder groups to be like, and now we're protecting shareholders. I'm like, no, you should have had a conversation about how the money was being invested before they lost it. It's like, it's like arresting the guy who just burned the entire neighborhood down. And it's like, well, maybe you should have like arrested
Well, there's
him at
also
the
some
first arson.
Schadenfreude, and there's also some like, well, I'm losing money too, so you should share in the losses with me. You shouldn't get
Right.
paid $180 million to run Intel.
Right.
Given that I'm not up on Intel anymore. So I think that's like just human nature.
Yeah, it's very much human nature, but you would just hope that, I mean, again, all of these people on the investing side and also on the corporate side, they're getting paid a lot of money, allegedly, for expertise, skill, et cetera. And so you would hope that all of these people have basic plans, basic procedures that actually make sense, that actually hold up under scrutiny, so that even if they're getting paid a little more in a down year. They go, look, we know that this business will have down years. It's in the budget. This is what we planned for. This is the 5-year. This is how this works. It's consistent. And I know there are CEOs who are still getting paid a lot of money who are not being held over the coals by their shareholders. I'm not commenting on those people, but there's just Intel's been a not great situation. And
it's
so
underperformed for a couple of decades,
right? And with Intel, well, they've also just gotten crushed by several other people, and they look like they're the
AMD,
disrupted company right
Taiwan
now.
Semi. Yeah,
No, look, if that
everyone's
guy-
eating their lunch.
Oh my God.
Look, if I was on any of those compensation committees, and the guy took the job right now, I'd go, okay, look, you're taking a really, really rough job, and we're super willing to get you, crazy rich, but you're gonna have to actually deliver before you get
Also,
that,
you're
right?
taking a really tough job, but you're taking it at the bottom.
Right. If you the whole thing should be, if you pull this off on a 5-year basis as defined by blank, then yeah, you're going to probably get a few $100 million because it meant you probably produced tens of billions for other people. Fair. We'll make you generationally wealthy for that. But the idea that during the attempt you should get paid that much, no. I think that's ridiculous.
Here's an advance on all the great things you're going to do.
Here's an advance on saving the world.
I just feel like there can't just be one person who would do that job and their price is 180. Take it or leave it. It just doesn't sound like the way the real world works. You need a lot of consultants to make it so that seems normal.
Well, I mean, and part of it is because I don't know that there's the same thing. Like there's a similar thing with Marissa Mayer at Yahoo and stuff like that, where
ridiculous.
that was. I don't really know that she had any. I don't know that she had a shot of saving that thing.
No.
And so it almost seemed like the pay package to her where they were like, look, your career is going to be over.
She has star power, though.
Yeah, your career is going to be over, but you're going to look great in the Esquire piece.
Vanity Fair.
I have no idea, right? So I don't have a super strong opinion on that. I just think generally executive compensation needs to be improved. It needs to be tied into operations, capital allocation, and the shareholders need to stop doing this like, oh, we don't care, now we care thing. And it's really disruptive.
Also, there's a very finite amount of actual shareholders.
Right.
Because if you own this in ETF, you don't care who gets paid what. And most people that own individual stocks, if you look over the decades, their holding period has declined.
Look at this chart of Intel divided by the semis. Not great.
That's not great.
No.
It's probably the worst in the whole group. Last thing we're going to do before we get out of here. How bullshitty is ESG on the scale of 1 to Elon Musk is a god?
They removed Tesla? I don't understand.
Elon Musk is now actively tweeting that ESG is the quote the devil incarnate.
Did he? No, he didn't.
It was a little theatrical. No, it's an outrageous scam, is what he's saying. Is it an outrageous scam or just like an old fashioned scam, or is it really great for the environment? I'm just kidding.
Well, I think he also mentioned that Exxon's a top 10 by this ranking.
Elon's take is that ESG is so he actually missed what the
because Tesla was kicked out of the S&P 500.
They probably got
ESG
kicked out
index.
for the G, right?
They wrote a blog post, of course. S&P did a TikTok explaining that
right.
there were like racial incidents that they don't feel have been fully corrected and whatever. But Elon's point is, out of all the public companies, they've probably advanced the ball more for clean energy than any company in history.
Fair, no?
Right.
I think that's fair. I don't think GM, Ford, all these other companies are doing as much with EVs, if not for the success of Tesla. No way. No way. But so he actually missed the real reason why it's a scam. The real reason why it's a scam is it's the S&P 480 with quadruple the basis point fee. It's like, we're removing a few stocks and we're going to charge 4 times the amount for basically that's the scammy aspect of ESG. But what he's basically saying is this is about furthering the leftist agenda, and there's probably a lot more emphasis behind closed doors on the S part, the social part.
Yeah, I've.
We want you to now dance through those landmines that I've set up for you.
Thank you.
Close everyone's mic, please. I want Dan to have the floor here.
Right. So the VC fund, Ankylos Bangladesh, that I'm a GP at my good friend Rahat is a lead partner on. He lives in Dhaka, Bangladesh, and he's helping people in a frontier market
That's not ESG. That's impact investing. That's the real thing.
Well, yeah. So we're mixing up terms, right? And so we had this like idea, right, where we're like, okay, we're going to go to one of the poorest countries on the planet. There's a lot of smart people. We're going to help them like build like healthcare for the country.
Oh, healthcare.
Yeah,
all right.
And all this other stuff, right?
Say.
And then we started having conversations with some like ESG related entities, and so I had to get up the curve on how all that worked, and it's a blanket term that means very different things to very different. So, for example, U.S. ESG versus EU ESG.
In Europe, they're serious about it.
Totally different thing.
Yeah.
Like this is like the Europeans are not playing games with this. There's so much paperwork. Oh my gosh. But in America, it is. I think it's a particularly dangerous concept in the United States because of the political Twitter weird media morass where it's just too dangerous about becoming really arbitrary, and and there's also just weird agency costs and like timeline asymmetries. So do we want to, as a society, not use as much fossil fuels? Yes. Is it smart to not invest in metals and fossil fuel production? No, we're
learning that now.
We're learning that the really hard way, right? And there's a dangerous externality problem here. And the other thing is like I just
Grantham talks a lot about that. It's like this well-meaning thing where we've starved
very well-meaning.
Vital industries,
right,
and crushed employment in vital industries, and we've lost a lot of know-how,
right,
and a lot of technical capability by underinvesting.
Yeah, and also not only that, but it contributes to this. I mean, I think one of the saddest things in our society right now is how willing everybody is to demonize large groups of people. If you're a white guy who does blue collar work, if somebody sees a picture, if I could tweet a picture of a random guy who's like a carpenter in West Virginia, and I could be
voter.
like, yeah, people are going to rip that guy apart, and these are people just trying to make a living. And it could be any other demographic as well.
That guy,
right?
Yeah,
and I just think it's very dangerous to apply moral judgments to things which are clearly vital to the functioning of the economy. I think you should use policy stuff to incentivize and to create like a glide path for us to move off of this onto that. But this attempt to like kind of choke things out and demonize this or help this, it's just not productive. And then you end up with the bigger problem is when you try to put a layer in like ESG. You go, okay, we already have all this compliance and we have all this weighting stuff, liquidity stuff, how we're distributing the product. You have all this kind of costs that go in there. And then when you insert this ESG layer, you're adding another layer of intermediaries who it's not that they're not qualified to invest, it's that there's just too much to know. And so they're making decisions where they have a very, very narrow perspective, and they're even within the narrow perspective, they're looking at it from one very specific set of guidelines. And so they're kind of overcorrecting because they're going from nobody's considering these issues to only considering those issues and only considering them from a single perspective. And so I think it's like a very admirable and good thing. And I would note that a lot of the best companies of all time like actually do incorporate a good amount of this.
There are some very well-known ESG, I don't think they refer to themselves this way,
right?
But there are some very well-known hedge funds.
Sustainable investing and things like that.
What's the guy, Blue something or other? He's very much at the forefront of that.
I'm blanking on his name. I know what you're talking about.
Yeah, but he's like very well respected because he's running a hedge fund based on a code. It may not get the stamp of approval from XY index, but he's basically saying like, these are the types of things I will and won't do, and his investors want that.
Right.
And it might cost basis points of return, or it might be additive, depending on what's in favor in the market.
What's interesting is there's actually people who have the exact opposite perspective, which is there are businesses where if you withdraw capital from them, they will go out of business. And so you, by not investing, are actually harming that thing that you think is evil. But there's other businesses like cigarettes, for example, that have so much cash flow coming off of them that they certainly don't need investor capital. But somebody has to own those securities as long as it's legal. And so there's a different perspective actually, which is, and I think this actually makes some sense in a weird way, which is if you're like a charitable foundation or you're somebody trying to make the world a better place, it almost makes sense to buy sin stocks because you're actively rerouting the cash flows
take
from
the
those
dividends,
things,
take the profits, and put them somewhere else.
put them into something that's good. Like you can weaponize the bad thing to fight the good thing, and and that's something that
Buy Altria to fund the blockchain. I get
Look,
it.
we have a small percentage of clients who are very committed to not having a single cent that they make go into things that they don't agree with.
Right.
And our job as wealth managers is to respect that and find solutions. But then we have clients that are kind of on the fence. They get the arguments against putting money into things, but they also want returns and they don't feel that strongly. So for those people, the right answer is, well, you're giving to philanthropic causes, and maybe it's the environment, or maybe but take the money and then try to make a difference with the money rather than trying to make a difference with your investment posture, if that makes sense.
Well, because the point is you're not going to make a difference with your investment posture, and that's I think the underlying problem.
So I don't think there's universal agreement on that. I do think that in Europe especially,
in Europe it's a very different thing.
So I think that there are people who really do think that with their investment posture, withholding money from some industries or giving double to others, that they are going to make a difference.
I'm a big believer that you absolutely can drive change by adding capital,
but not by withholding it.
Look, guns, cigarettes, oil.
Someone's going to do it.
Not someone's going to do it. There's so much cash just coming off of the existing. They don't need. I mean, what is Altria's dividend yield right now? 10%.
We broke a record in gun sales last year.
Right. I mean,
they're not starved for capital.
Right. These guys are not, and they're paying. These are all over like 6-7% dividend yielders right now. So the idea that by not buying those stocks, you're going to somehow like harm the gun industry, I'm like, no, it's just not going to happen.
Altria is 7%.
So adding capital, I think absolutely works. And so a lot of like the European institutions, things like that, they're being very intelligent about like what problem are we trying to solve, what's missing, how do we do that, and they're not spending a lot of time. They will say that like you can't like participate in like we don't want you to fund a venture-backed company that is like a cigarette distributor. We're not interested in funding the expansion of that industry, but they're really focused on like how can we actually drive positive change.
Let's say Duncan comes to you and he's a huge family office, and he says, I want you to create a version of your portfolio just for us.
Yep.
We're going to give you enough capital that'll be worth worth the paperwork, but you cannot put my money into the following 5 sub-industry groups for any reason.
Right.
You'd probably take the money and figure out a way to do it.
All day.
So I think most people would.
Right.
Okay. So it's here to stay.
Yeah.
Okay. Elon Musk probably is having a lot of fun with that argument, but I think he's genuinely pissed that he's not being recognized by the people who claim they love the environment. I think there's a little bit of rage there, and I get it.
Yeah,
Same.
I think even if you agree with every criticism that's ever been lobbied against Elon,
you can't take away from him that he's advanced the ball.
It's also just, I don't understand it as a political move because that's a thing that's going to be a fight.
Oh, yeah.
Right? You're not like saying Procter & Gamble is not ESG anymore, and they're going to privately send you a letter and say we're very displeased. Like, you're going to get at a big fight, and I don't understand.
That's the most interesting. That's the most interesting argument. Talking about like, all right, somebody breaks the law, whatever. Now what? This thing's going to end up in a Delaware Chancery Court. Imagine the officials that serve on that court in Delaware. They're going to enforce him having to buy Twitter.
Right.
And then what happens? He says, "Okay, I see the judgment of the court." No. Does anybody working for a bankruptcy for an M&A panel in a court in Delaware want to personally tell him that he has to follow through with this transaction? Probably it's not going to be the best week of your life.
My take on the Twitter situation is that, and Matt Levine has always been this like great sort of like postmodern nihilistic take on finance that is really great writer. But now like the world has come to him, and it's kind of weird. It's kind of like if a comedian goes from being like a commentator to being like a prophet. Seer, a prophet. Yeah. And
Matt Levine's like famous.
Matt Levine's like he's like one with the flow of the universe right now, which is really scary.
No, but he gets it. Tell me what the rule is. Okay, so what?
Right. But I think the difference is right now, that stuff always happens when it's like one rule or two rule, or it's always, there's always people on the edges playing games, and I'm really weirded out by the situation because now you're in a situation where there is a lot of liability for a lot of people in a lot of different ways, multiple states, multiple different types of cases. This thing has to get clean like pretty fast, or
there's no rule of law.
Or yeah. And so like the Twitter deal spread in a lot of ways is kind of like a proxy on the rule of law, because there's a lot of opinions out here, but he waived his right to diligence. He's openly admitted that he was aware of whatever bot problem he's making up. The bot disclosure has been in the things the whole time.
Yeah.
He signed the merger agreement. He has the financing.
What is any merger agreement worth
Right.
if this doesn't get enforced?
And not only that, if the board doesn't sue him to force performance, all of them are going to get hammered for this. And I don't know if D&O insurance will cover this. Like, I don't know.
They'll get sued into the Stone Age by shareholders because the stock will collapse to 20.
You know what I'm shocked? I'm shocked that, and we might walk out of here and open up the news to see this happen. I'm shocked that a Carl Icahn or a David Tepper or something like that hasn't swung in, bought 6%, and just said, hey, close this, or I'm going to bury all of you.
Ain't going to be Tepper, but
I mean, no, he's busy, but
it could happen.
You just need you need another billionaire who's a little bored who doesn't mind spending legal fees.
You hear that, Carl? I know you listen each week. I'm told. All right, listen, we've kept you long enough. Let's do favorites, and then let's crush this this bottle of Añejo. It's been quite a month.